Yeah, let's get started with this portfolio management. Typically, from an exam standpoint, in level one, hardly the weightage is 5%. But probably you should look at this as what you would be doing at the end of the entire CFA. Because that's the reason level 3 constitutes almost 55% weightage only to portfolio management. So level 1, the focus is more just to understand the basics of what we mean by portfolio and the basic calculation. Some of them we must have looked at already in quant. The portfolio risk calculation, the formula used for finding out the portfolio variance and portfolio returns. So slight building on those kind of calculations and understanding the basic context behind the creation of the portfolio. That's what we are typically looking at. Though the entire subject is split into 4 chapters, the size of them is relatively smaller and but very critical, because any subject which is having a very less weightage from an exam standpoint, the onus is there in terms of making sure that you don't miss out any of the questions, because one question wrong could result in a percentage falling drastically. So that from that standpoint, it adds a lot more value, right? And that too, this subject being the core of a CFA, core job of a CFA, it's better to get some kind of a basic hold on it. So the first chapter is giving us a simple overview of the entire process. See, we all know in regular scenarios also, uh, diversification is a very important strategy, right? Probably not just in the world of investment, right? Let's say if I'm only looking at one X particular kind of a job, or X company X kind of a job, probably it's more risky for me rather than keeping my options open a little bit, right? So that is what we are calling as diversification. I mean, it is applicable in almost every world, right? Probably instead of specializing in one single subject, we try to do dual specializations, we try to do a lot of things just because we want to keep our options a bit more open, which are what are nothing but diversification strategies. And because of that diversification, what we are trying to achieve is we are reducing the risk, right? The same logic is going into the world of portfolio also. Investing in one single security is going to sometimes it may be very profitable, sometimes it may end up into a big loss also for us. So that is where the whole of portfolio management as a concept has come up. Diversify with an intention to reduce risk. That's the major. If at all I have to define portfolio management in one single sentence, I'm doing a diversification with a prime intention to reduce my risk. Not with an intention to generate abnormal profit. Portfolio management never targets at generating abnormal profit. It primarily targets at reducing the risk without compromising too much on the return. I compromise on the return, but with a little compromise on the return, probably I may be able to reduce my risk drastically. Risk is nothing but what? Uncertainty in the amounts which I am going to get. So probably it's like getting 50% profit with a 5% chance, are losing 50% with a some percentage chance, versus getting 10% consistently. That is what portfolio management tries to achieve. Okay, your profitability 50%, fine. If that is not assured, then probably it can really have a big impact on your overall profitability and your overall well-beingness, because as long as it is doing well, you're happy. The moment it doesn't do well, you're losing out. But the portfolio is created in such a way that even if one of them is not doing well, the other one will do well. Both of them are compensating each other. Because of that, you may not gain heavily, you may not lose also heavily. And the portfolio management is always looked at from the negative aspect, right? It prevents my, or I don't use the word prevent, at least it tries to reduce my downside, right? Prevent is a very wrong word to use there. It reduces my downside, it reduces my chances of loss, or even if I lose, it reduces the volume of the loss for me, especially when I'm going with it. So here in this, the key topic that plays a role is correlation. The moment I'm choosing two securities, based on the correlation between them, I have to choose. If the correlation between those two securities is very, very high, we'll demonstrate it when I'm doing the calculation. If the correlation between the two securities is very, very high, there is no diversification benefit literally. Only if the correlation between them is very low, probably -1, that is where the diversification benefit actually comes up, right? And we have to understand that portfolio doesn't mean it's a loss prevention. It does not guarantee anything, but it's a mechanism where you can work out to typically reduce your chances of loss. And on that grounds itself, we have what is called as a modern portfolio theory. What it says is, any investment which you are trying to do, don't look at it only from the return perspective. Always evaluate it from the risk plus return kind of a standpoint, not just from a return standpoint. You use risk as well as return to evaluate the portfolio. So, any return expectation you are going to have, you have to believe that there is an impact of risk also in that exercise, right? So so from that standpoint, it has even brought out a calculation called diversification ratio. What this does is very simple. You create a portfolio, and for that portfolio, you find out the standard deviation or the variance of that portfolio, and you look at the individual securities which you have created in the portfolio. Let's say I had shares of Infosys, I had some shares of Wipro, I had some shares of DLF, right? Now I know the individual standard deviations of each of them. I take a simple average of the individual standard deviations that is there in the denominator. In the numerator, for whatever the final portfolio that I have formed, what is that final portfolio? Probably 50% in Infosys, 30% in Wipro, and 20% in DLF. Using this combination, whatever the returns that come, I can find out the standard deviation of that. That standard deviation divided by the average of the individual standard deviation is what I am calling as the diversification ratio. So the denominator is a simple average. The numerator is actually the portfolio, right? So if the number comes down drastically, if the ratio value is much lesser, it means that my portfolio is a very good portfolio, because it has reduced the risk quite drastically, because standard deviation is a measure of risk for us. So the standard deviation has come down means risk has come down drastically by the creation of a portfolio. So the lower I get that value, that is, I'm getting a very good diversification benefit by creating this kind of a portfolio. That's one thing, one way we can evaluate the goodness of the portfolio, right? I'll look at the diversification ratio. If the diversification ratio is close to 1, probably there is no benefit that I am getting by doing this combination. Whereas if the diversification ratio comes much below 1, 0.5, 0.3, the lesser it comes down from 1, the best is the diversification benefit that I get out of it. So now when you look at it from the other side, which is from the various people who actually use this portfolio management process, you see literally everyone needs that portfolio management process. right? If you look at individual investors like us, we use portfolios because see, most of our investment needs, they differ in terms of time horizon. Sometimes we do for a investment for a short term, sometimes for a long term. Some of us do for a short term, some of us do for a medium term. So, and there is a risk tolerance level that differs from each individual to individual. I may be a risk taking, you may be a risk neutral, he may be a risk averse kind of a person, right? So the risk tolerance limits changes. So the strategy which we generally adopt, the portfolio management strategies that we generally adopt, are based on these characteristics of the any participant whom we are looking at, or probably the income needs. Income is nothing but, do I need a regular source of income from that investment, or can I lock my money, or am I not interested in getting anything in the middle? More of is it, if it is accumulated, is it fine, or do I need something in the middle? That is what is my income need. Let's say for a retired person, there is no point for him to accumulate something for 10 more years and receive everything after 10 years. For him, it would be better if he receives something month on month, right? So, and probably for a person, for a youth, for a young person, probably because he is earning and all, he does not require everything to come every month. For him, it's better if it comes as a lump sum after 10 years or 15 years. So that is what we are calling as income need. Do I need some kind of income in the middle, or can everything be accumulated? Again, that changes from person to person. And the same way, liquidity. If I want to get out of it, I have invested. If I want to get out of it, can I get out very quickly? That is what we are talking of, the liquidity. So some people, I mean, in sometimes, because I plan for a long term, I'm least bothered